it's an easy question to answer. But Dave and I were talking one time, and we were talking about how difficult it is managing money in the last 5 to 6 years, after essentially 25 years of what were basically easy markets to manage money, and they generally went up, and they went up in unison, and there were a few hiccups along the way, but they were short-lived, and everything changed in 2008. And Dave said to me, when we were talking about how difficult it is to sometimes do the right thing for customers, and Dave said to me, I'd rather lose clients than money. And it sounds like a flippant response, but it's essentially the attitude that everybody who manages money should have. You have to do the right thing for people, even if they don't realize you're doing the right thing for them. And Dave and I spent a long time talking about this afterwards. And the more time I've spent with these guys up here, sitting in on research meetings and on phone calls and stuff, I came to realize that they're very, very serious about what they do. They think about it, and they do the right thing all the time, and that's incredibly important to me, because sometimes it's not the easiest thing to do, because you're going to get a lot of flack for it. And Dave, I know, has spotted an awful lot of things early and been wrong for a while. And that's, it's an uncomfortable seat to sit in, and sometimes you can be tempted to do the wrong thing for the wrong reasons. I don't think it's ever off the table, because if you take any span you want, and the world is inflationary. It always has been. We get bouts of deflation, but never really prolonged periods. The cure for deflation, as we're seeing now, are inflationary measures. They're just not gaining any traction at the moment. But I think when you say there's been no inflation, it's actually not true. Dave had a great slide up there. The money, as Tyler said, has tended to go through the mechanisms it's been administered to the market. It's gone to the wealthy. This 1%, 99% hot potato. The 1% have got richer, and as the money, several $1 trillion has been printed and has gone largely into the hands of that 1%. What you've seen is severe inflation in the kind of assets that those people want to chase, like collectible cars, like expensive art, like penthouse. There's a $100 million penthouse apartment in New York that sold a couple of weeks ago. And I think if I'd told anybody, 10 years ago that you'd be worth $100 million and not be able to afford a penthouse apartment in New York, you'd have told me I was crazy. But so that's where there is inflation. I think the deflationary part of it, it has taken a lot of people by surprise. But what we're seeing now with the dollar strengthening is only going to cause more problems. There are a series of dollar pegs around the world. We've seen this, the Swiss National Bank remove their peg from the euro, and I actually want to talk about that in a second, because I think that's incredibly important. Say for reasons I'll come to in a second. But as these dollar pegs around the world, some of them are hard pegs and some of them are de facto pegs. But as the dollar keeps strengthening, a lot of these countries are going to be importing deflation into their economies, which is something that's going to be a severe problem for them. So you're going to see a series of dollar pegs come under strain. We've seen the Bank of Canada, which obviously isn't pegged, but we've seen them cut rates, which surprised a lot of people. We've seen Denmark do the same thing, although they're more tied to the euro. And these pegs are going to come under pressure. You start to see a series of pegs go, and it creates a lot of uncertainty, a lot of fear. And that's when people things start to get a little bit unhinged. And just coming back to the Swiss National Bank, and as I said, I think this is really important for a couple of reasons. The first one being, for those of you that aren't sure what happened, the Swiss National Bank in August 2011 pegged the currency, the Swiss franc, to the euro, because people were pouring into the Swiss franc. It was creating a very strong currency, and that was causing problems for the Swiss industry. And Switzerland is essentially a country controlled by business. They don't really have an awful lot else except world-class businesses. So the pressure was on the government to stop the Swiss franc appreciating. They pegged it to the euro to stop that happening. And in the statement that they made in August 2011, they said two things which are really quite extraordinary. First of all, they said that they would not tolerate a Swiss franc level outside of 120, which, if you think about a group of bankers saying they won't tolerate market forces, there's a lot of hubris in that statement. The second thing they said was, we will defend the peg with unlimited quantities of Swiss francs. Now, they've done that for the last 3 years. All of a sudden this week, after saying on Monday that this peg to the euro was a core pillar of their monetary policy, on Thursday they removed it. And what we saw then was unprecedented. We saw a 30% move in a G7 currency. And by the Swiss doing that, they proved that right now, after 5 years of very coordinated monetary policy from the world central banks, it's now every man for himself. And that's a very dangerous world to be in when you have this policy divergence. And secondly, it's the first time in the last 6 years that we've had a central bank lie to us. They've essentially told us one thing, and they've gone against it. And the whole of the last 6 years, this rally from the March 2009 lows, has been predicated on essentially one thing, and that's the central bank saying to investors of the world, it's okay to buy this. Go out there, put some risk on, interest rates are going to stay low. This whole idea about forward guidance has been very central to that, to get people comfortable so they'll go and invest. The flooring of interest rates has been part of that, to stop people, like the people in this room, being able to save money and having to invest it. Now the Swiss bank have actually come out and not done what they've said. It starts to put the doubts in people's minds about the credibility of other central banks. So the whole idea of forward guidance, which has been central to every central bank policy in the world now, comes into question. And with a group of investors who are sitting on 5, 6 years of profits in equities, bonds, everything's essentially gone up over that time. If you're looking at those positions, you start to revalue them and think, do I take some money off the table? And the exits are going to be very, very small. So I think that Swiss bank decision is really, really important, and people need to watch out for the ramifications of that. So it's a long-winded answer, but I think there is inflation. It's concentrated. They're going to keep doing everything they can to beat deflation, because the answer to inflation is always inflation, and they will be successful. At some point they will be successful. The question is, when they're successful, can they generate this magical 2% inflation figure rather than 5, 6, 7, 10, 12% inflation? And I strongly doubt they're going to be able to do that. To put this in perspective, the estimates for the losses on this portfolio that they've bought with all these euros that they've been holding this peg with is about 80 billion, somewhere between 60 and 80 billion Swiss francs. Now, with the size of Switzerland's population and their GDP, if the Fed were to lose the same amount of money as the Swiss National Bank have, it equates to $2.8 trillion. So that loss is going to be dumped in the laps of the Swiss taxpayers next year when they announce their account. So it's a staggering amount of money.
There's only 5 million people in Switzerland,
yeah,
right?
Exactly. So that's exactly. It's like $100 and something thousand a person. It's crazy. And when Mark talks about, is this the year that this stops, Dave said, well, not Japan, because they're going to keep printing, and they are. But the big issue we have here, and the central banks themselves have said it, this is a confidence game in the true sense of the word. This is all about instilling confidence in people to get these frozen up gears, cogs, whatever you want to call them, moving again. And once you lose confidence in one central bank, you lose confidence in them all, because they're all doing the same thing. And so if you go back to the 1960s, before the euro, the Deutschmark was one of the biggest currencies, or the biggest currency in Europe. It was pegged to the dollar. And there was a lot of political pressure on the Bundesbank to devalue the Deutschmark. And the Bundesbank had promised the Fed that they wouldn't sell dollars for gold, which they were entitled to do under the Bretton Woods Agreement. Eventually, in 1969, the German government broke the peg the German government devalued the Deutschmark against the wishes of the Bundesbank. In May 1971, they broke the peg against the wishes of the Bundesbank. And 3 months after that breaking of the peg and the fact that the credibility of the German central bank had gone was when Nixon shut the gold window and the entire global monetary system changed. So these events can ripple outwards, and central banks, which is why I'm talking about how important it is that it's every man for himself now, because as goes one, as goes all of them, and the Swiss bank credibility is frayed, it's in tatters. And if we get another one go, if the Fed actually talk about hiking rates and then they prove that they can't hike rates because the economy is not strong enough, and they go back on that and they come out with QE4, QE5, credibility's gone, and that's when I think this stops. The market takes away the printing press rather than them deciding not to press the button anymore. Long term for me, I live in Asia. For me, I think the story of the next 10 years is arguably going to be India. It's a tremendous opportunity, and they've finally they've elected a guy, Narendra Modi, who's a genuine leader, and the first one we've seen in a while. And there's actually some really good things happening politically in Asia, a place like Indonesia, Philippines, where we're getting leaderships that are real and they're not corrupt and they're cracking down on all the things the problems that you have in places in Asia. India's such a huge, the world's largest middle class. It's a country of very, very smart people, upwardly mobile people. They're ahead of the curve compared to China. So I think there's going to be some tremendous opportunities in India going forward. I couldn't not mention gold, obviously. I think gold is something that everybody should have an allocation to. Whether you hold it for 10 years or not, I don't know. But I think at some point in those 10 years, you're going to have a chance to sell it a lot higher than it is here. And other than that, I think Dave's right. You need to find yield if you can find it, but you need to be careful about how you find it. And the uranium play is something. The company you're talking about, I've had positions in that for some time. I think it's a great position. And so that's generally where I'm looking is more away from the US, which I think is a little bit overvalued. Places where you need a little bit more expertise. The ETF phenomenon, as I call it, you can't just buy India. There is an Indian ETF, but I wouldn't advise you to buy it. But if you can go in and look at the companies, read research and find the companies that are really well exposed to the growth in places like India and the Philippines and Indonesia.
You mean like if you ran an Asian fund, if you had an Asian mutual fund, for example?
Well, yeah, there you go. But you need, and the GAVCAR guys are the best out there. They know these companies and they go and they find them. But it's tough to do from here, right? You need people who go to India and go and see these things. But that's where I think you're going to see some real opportunity.